Well, welcome to our weekly High Rock video. I'm Scott Tomlinson, and with me is my partner and colleague and the founder of High Rock, Paul Tepsich. We're going to chat today about what we see happening in the global economy, financial markets, and the world of wealth management, and how we're adjusting our investing strategies accordingly. If you are a new listener, we ask you to learn more, and you want to learn more about High Rock, please feel free to visit our website at www.highrockcapital.ca. For our clients, you should have received your fourth quarter and year-end of 2017 portfolio summaries. We have a new wealth management system. I did mention in the email to clients that there was a bit of a glitch with the fees. You will actually receive from Raymond James a statement of fees for 2017, as well as you can go online to the Raymond James Correspondent Network through your My Documents, and you can check your performance and fees reports there as well.
And that mistake will be corrected for the second quarter?
Yeah, the fees. It was just a glitch on the coding. Raymond James was coding it in a different way than it just didn't get picked up by the portfolio summary. So yeah, in future that will be corrected. Yeah. So, Paul, let's start talking about our models, and if there's anything new that you need or want to enlighten our clients on.
Sure. Not a lot of changes in the models. I would say just in fixed income, rates continue to back up a little bit over the past week or two. They seem to have stabilized, and in fact, even today, improved a little bit. So we'll get a bit benefit of that in some of our fixed income component. In the tactical model, nothing in global. Again, in the tactical model, we did add, we've talked a few times about our positioning in cobalt as it relates to the electric vehicle market. We did add to our position in cobalt. I was at a mining conference put on by TD last week on Thursday, and we had a one-on-one meeting with the CEO and the COO of Cobalt 27, which is a stock we had a position in. We added, another 25% weight into that on Thursday afternoon. Actually, in fact, it's trading up from $12.50 where we added to $13.50 this morning. They're effectively a streaming company. So what they're going to do is go out to a miner of nickel, copper, and cobalt. Cobalt is largely a secondary byproduct of copper and nickel. And they will effectively buy their stream forward for the life of mine, which in many cases could be 20 years. And I think this stock is going to really take off here over the next year or so. It is one of our largest positions. Another position we've talked about in the past, is Sherritt. Sherritt actually surprisingly issued stock last week. But as most of you are aware, we also have a bigger weight. We own some Sherritt stock, but we also own some Sherritt bonds. And the effect on the bonds was pretty good because they put in, I'm using my hands here, they put in equity underneath, and the bonds are up here. So that equity underneath helps the bonds a fair bit. And those bonds went up somewhere in the vicinity of 5% on that day. Last week, which I believe was Tuesday night. So our bonds are not marked at the mark-to-market as of yet. We mark our corporate bonds at month end. So we should have a good impact from those Sherritt bonds, which all of our clients own at this stage. So the cobalt story is working well. That's it.
Okay. One thing that we did chat about earlier a little bit briefly was credit spreads. Credit spreads between government bonds and corporate bonds, and then high yield bonds have started to widen a little bit in the United States, but in Canada, not so much, right?
Not as of yet.
Okay.
Yeah, still pretty tight. I mean, the market's off SNC. It's barely noticeable.
Right.
But we should keep our eye on it.
Yeah, absolutely.
Because I just got off a phone call with a guy, and bonds lead. Government bonds lead capital markets. Corporate bonds lead equities, so it's important. So we'll pull up a chart next week.
Yeah. Or we can pull up a chart this week.
Excuse me.
As far as our broader global perspective, we mentioned last week that we expect that central banks will start to withdraw liquidity from the system on a global basis. We certainly saw the Bank of Canada raise interest rates, which was something that we had anticipated. But again, there's a lot of conjecture as to what that will mean. We'll talk about that in just a second. But we do also see decisions coming from the European Central Bank and the Bank of Japan this week, so we'll be monitoring that very closely, seeing what they're doing. We don't expect any interest rate increases specifically, but they could, again, start to pull back a little bit on their bond purchasing.
Right, that's the important thing.
Exactly.
The size of their balance sheets.
Bank of Canada, we got their monetary policy report last week. As expected, they raised interest rates in Canada by 0.25%. Their expectations of what that means is that they do and have built in that higher interest rates are going to start to impact the consumer. And looking forward, the consumer is expected to contribute a little bit less to GDP, and it is anticipated that we may have seen the best GDP numbers behind us now. That'll also affect the housing market, though, I would imagine, right? The consumer, interest rates higher, consumer pulling back a little bit.
They're so over-levered, it's crazy.
Yeah, so there could be some residual impact on the housing market, which is a fairly significant part of Canadian GDP at this particular point in time. Finally, NAFTA. So, sixth round of negotiations started today.
I think so, in Montreal.
And they're talking about this being a pretty important series of negotiations, that if they don't come up with enough to keep the U.S. interested in negotiating, that they may just pull right back. So anyway, we'll be keeping an eye on that. But that obviously will have some impact on the Canadian dollar. I've read anywhere 3 to 5% if it goes south.
Makes sense. So. I mean, get back up towards 129, I would imagine.
Yeah. The IMF, International Monetary Fund, came out with their World Economic Outlook this morning. They do see slightly better, by about 0.2% global economic growth. Most of that is coming on the back of the U.S., and they've built in now U.S. tax reform as a catalyst for better U.S. economic growth, and that should, or is expected to push global growth higher. The one risk that they mentioned that we talked about earlier is, and we have been talking about, is that asset valuations continue to be very, very high on a relative basis, pretty much building all and then some of all this expected economic growth into current asset prices.
Do you think they're trying to jawbone stock markets down or something?
Well, I would think that they're trying to get investors to think about how much has already been built into the markets. When we look at earnings, and we look at how even increased expectations for earnings in the U.S. equity market, how they are still pushing prices higher, and yet prices are 30% above their 10-year average. So I think price earnings ratios are 30% above their 10-year average. So I think those things are what they are trying to highlight here, and certainly that's a risk going forward. Another risk, of course, is that global debt is at record levels, and we see interest rates doing nothing but going higher potentially, and in time that will have some impact. Last week we saw data come out that said U.S. credit card delinquencies are about 20% higher than they were last year. I think that's something to take into account.
Big number.
Well, apparently it's not as big a whole number as it was back in 2007, 2008. but it's climbing, and I think that's what we have to be somewhat cognizant of too, the impact on the U.S. consumer of higher interest rates and higher debt burdens.
And auto loans as well,
Absolutely.
defaults.
Absolutely. On the back of that, on Friday, we saw consumer sentiment decline for the third month in a row. After a great sort of Christmas season, we're starting to see the consumer shift a little bit in their attitudes, and we'll monitor that. It doesn't mean anything specifically, but it's the trend that we want to maintain some sight on.
Or change in trend.
Well, yeah, if that's the case, we want to make sure that we're watching that. Finally, of course, it's all in the news, the U.S. government shutdown. It historically hasn't affected stock markets. We don't anticipate that it will this time, but it actually may have some impact on the U.S. economy if it continues.
Yeah.
The likelihood of it continuing, I don't know. Hard to say.
Can't handicap that.
No. So that's it. That's all we have to say. Certainly, if on an administrative note, if you have not received your fourth quarter update from us, please get back to us as soon as possible. And if you have any questions regarding it, we've had some conversations with clients, but we're always available and happy to have conversations with clients whenever they want to have them with us. So that's it for this week. Thanks for tuning in, and we look forward to seeing you all next week.
Have a good week.
Take care.